You remain overwhelmingly pro-Brexit.
Of course.
Even if it was just a clean, even if it was a with not a deal, just get out. And you say this,
it's entirely unnecessary, but if that's what it took as a hard Brexit, it would be superior to the alternative. I don't think it's going to come to that. But
why are you? There's people that think most people that have a horse in the game, and I'm talking about Blankfein, or previously, they look at Brexit like it's the end of the world, the end of globalism. You say, when is freedom a bad thing? For me, it's like, how can one of the greatest empires in the world, the UK, how can they cede all that control to bureaucrats, unelected bureaucrats in Belgium? How would that ever make sense?
It's not a rhetorical question. I've asked the same question to some of the types of people you're referring to, and we'll never get a satisfactory answer. But I think just down to the question I asked that you're talking about in my notes, when has freedom ever been bad for markets? Just in a basic sense, the answer is never. There's never been a time where increased freedom.
Hence, they're called free markets.
Well, that's what we were kind of brought up to believe here, right, in terms of our beliefs about American private enterprise. Now, within the UK, I do believe if Brexit were what its opponents have said, it would be bad for markets. If it represented a wall to doing more trade, I think the opposite. I think UK negotiating their own trade deals will lead to greater trade, and I think that there's tons of precedent in other countries. But I just want to point out, and I'm not going to get into specifically Lloyd Blankfein, but other critics of Brexit said the exact same thing when UK wouldn't join the euro currency.
Right.
It saved their economy. It saved their country that they didn't join that debacle of a currency 20 plus years ago.
But even with all this said and done, you still say Europe at large remains unattractive.
It remains uninvestable
basis.
From a risk-reward standpoint. Now, one of the things that I think could happen is a big unexpected bout of monetary stimulus, and that would absolutely spark their markets. It just kicks the can further. I don't want them to do that, but I don't think it's off the table. I mean, when Draghi talked about the bazooka, what's it been now, 7 years ago, he meant it.
Yeah.
And so to me, the issue of them trying to go more fiscal stimulus, markets respond negatively. It doesn't work. They're not willing to do what they really need to do to cure what ails the European economy. So for us, there's no scenario I see where things go really well in Europe and don't go really well in America. So that exposure we would normally have to European equities as global investors, we just are a little more U.S. heavy in that sense.
So, John, you're listening. Are you nodding or rolling your eyes?
To a degree, I'm nodding, Joe. Good morning.
Good morning.
I think that there's a distinction we've got to keep in mind, right? Look at the way the market getting complacent? You think about what happened in June 16 to the pound sterling as well as to the global equity markets on the announcement of Brexit. And then you see the way the markets perform this week. So while the other guest has very good points, David does, I think it's important to keep in mind that the impact of uncertainty on future investment, and that's why we're concerned. And it sounds like David is also concerned about Europe. Not only is it the uncertainty of Brexit that could slow down personal consumption as well as business investment, but we have slowing growth in Germany. We have certainly the Italian debt situation, which really is a big deal when you consider the two extremes in coalition governments trying to get everything together. And it's the third or fourth largest credit market in the world. So we're actually more concerned about Italy than we are Brexit.